Well, howdy, folks. Friday we had Jackson Hole and Jerome Powell making his speech, and I'd sort of classify the speech as neither dovish nor hawkish, and I think he's got a job ahead of him, really. You can see that this headline by Bloomberg says Powell has bond traders right where he wants them, full of doubt. We'll have a look at some of the figures right now. And really, the US dollar is going to affect most of the markets, and the prospect of further inflation or a reduction of inflation and rate hikes. Whether the Fed's going to pause and not hike at their next meeting, probably, and whether they're going to continue hiking or even starting to cut interest rates next year. Look at Jerome over here. He looks noticeably aged and a little bit pensive, really, if anything. And I think this headline from Bloomberg is a little bit misleading. I'll go through the article with you right now. So here's the Bloomberg article, and that's exactly what it says on that little picture I just showed you. Powell has bond traders right where he wants them, full of doubt. Fed chair says in speech that officials are ready to hike again. It's about waiting for September and jobs data. Now we've got Friday, we've got the non-farm payrolls. We'll see what's going on with jobs. And then as the numbers start to progress into September and beyond that towards the end of the year, we'll see where this is all heading and whether we're going to see more rate hikes or whether we're going to see a pause and potentially even a cut if the economy really starts to tank. There are no signs of that yet, and that's what's got actual bond traders and US dollar traders in a complete quandary, because some people think it's going up and some people think it's going down. If you have a look at some of the major funds and banks, like Deutsche Bank and JP Morgan and a whole host of others, there's completely conflicting views on where the dollar's going next. Let's have a look at this table down below us. And the heading of this is hedge funds and asset managers are in complete opposite camps. And this is how investors stand in overall in terms of the 10-year future equivalents. And you can see this red line at the top here, asset managers buying more and more, and the hedge funds selling more and more and getting rid of long positions. And you'll notice that these two lines, these two charts, the hedge funds and the asset managers, the hedge funds being at the bottom, asset managers being at top, completely opposite and actually equivalent in size and direction. It's super interesting. So an absolutely divided chart. And basically what this is saying, are interest rates going to go up or are they going to go down? And the hedge funds and asset managers are in completely opposite camps as far as that goes. And that means the dollar could go up or it could go down. And that's going to affect all of the markets, including things like commodities, natural gas, gold, oil, etc. And also the currency markets, the dollar against the major currencies. And of course, also the stock markets, whether we're going to see the stock markets go up or go down. We've seen quite a good, decent correction, about 5% on the S&P recently. Let's go have a look at the charts and see where we think these might be going. I'm going to start here with the dollar index. I'm trying to spend 1 minute on each chart so that this video doesn't get overcrowded and too full and too lengthy. So right at the beginning, I'm just going to ask you if you wouldn't mind giving the video a thumbs up and consider subscribing to the channel if you find this sort of information useful to your trading and or your investments or whatever you're doing with your money. This is the dollar index, and you can see we've actually broken through this green zone here, the 78.6% Fibonacci level, up into this top level here, which is this previous high from May, quite a long time ago now. We had this sharp drop in July this year, and then a gradual sort of steady rise upwards. Lots of wick tops and wick bottoms. Have a look at this chart, and lots of hesitation. Not exactly a bull run up, not exactly a stampede, one would say. Lots of hesitation and lots of umming and ahhing as this has moved up. A big hesitation at the 78.6% fib, which is obviously the area where it may have turned around and tried to turn around. And then just before Jackson Hole on Thursday, we pushed up through it. And then on Friday, funnily enough, actually the dollar just fell back a bit. It tried to surge higher and then fell back, just forming this doji spinning top type candle. What's interesting about Friday's candle, despite the apparent, I suppose, hawkish tone, which many perceive to be hawkish, I didn't think it was so much hawkish as sort of ambivalent. The market didn't move up, and I think the market reflects my idea on this, that there was not a great deal of support in Jerome's speech for further interest rate hikes, but he also left the door wide open to continue to hike. I have a feeling that we've probably reached the end of the rate hike cycle, and possibly we'll see another 0.25, but a lot of it's going to depend on jobs and inflation and how the markets are looking. US markets are looking pretty strong, and that's the only thing that's keeping the dollar up, I think. And as soon as we see some cracks, bigger, more Fisher-sized cracks in the market, we'll probably see the dollar begin to retreat. And certainly we do need a bit of a pullback in any event, because this has been one continuous move up. hesitant, but continuous and steady. Now, this candle on Friday, we didn't manage to close above this red line, which is an important level. That's the sort of top of the candle bodies over here on the left-hand side, and we didn't manage to close above there, leaving us with a hesitation candle. So that's all we can say about that. But remember that chart I showed you earlier with hedge funds and asset managers completely opposite and split and divided, different camps, as the article puts it, when it comes to bonds and bond yields. And really what they're talking about is interest rates and inflation and where that's going to lead the Fed and the overall economy. Right, let's have a look at some of the other charts on here. I'm just going to go through the US majors very quickly, from the euro going across to the pound and then the dollar yen. We saw the euro drop to the 78.6. Remember, the dollar's now gone through, the dollar index through at 78.6. The euro's dropped down to it, but not broken beneath it. And this is a key level for the euro. We continue to think that the euro is going to find some footing somewhere around here. We could get down to this lower level here at about 1.0630. But I think we may find some support here. Now, we've taken some long positions on euro, very small and tentative at this point, but still, we're thinking that this may hold here. And we'll just wait and see. That candle on the euro looks very similar to the candle that we saw on the dollar index. It's a sort of hesitation candle with a wick high and a wick low and a doji candle. You can see overall we've had one continuous move down, which is unusual for the euro, and we'd expect to see some retracement now at least, even if it is going to continue to move down. So we've taken a long position or a long stance, or our idea is to be long at more or less where we are at the moment. Same thing on the pound. Although the pound has broken beneath key support, and it's denoted by these three circles here, and the pound's just broken down through there. We've taken a long position on the pound. I'm not too sure, I'm not as convinced on the pound as I am on the euro. I think overall, economically speaking, I favor the pound over the euro, and I think there's more possibility that the pound will do better against the US dollar than the euro is going to do, because of just general economics and the numbers that we're seeing coming out of the Eurozone being weaker than that of the pound. And the overall pound chart, I think, lends itself to a move up slightly higher, up to about 1.33 or 1.34, potentially even higher than that. And if my charts just sort of unfreeze themselves, there we go. You can see our target is up here at this downward trend line. If I change this to a weekly chart, you'll see the weekly trend line. And then this green zone up above that, which is the previous highs going back into before 2020, 2018, 2020, somewhere around there. There's the downward trend line. I think we could reach up to there and potentially even get up into here if we see the dollar starting to come off. And I think there is potential for dollar weakness, but we're talking about a very, very divided camp, as you could see from those charts earlier. And also, if you read the reports from the various banks and hedge funds and people that I pay for and get information from, they're completely divided on where the dollar's going next, not only on the dollar, but also on the stock markets and on things like gold and natural gas and oil. So we're in a very tumultuous, mixed up market. So that's where we think the euro and the pound are going to go. Then I want to look at dollar yen, and let's have a look at this chart on dollar yen. So we've reached right up into this resistance level. I've got a single line drawn on this day chart on the dollar yen, and you can see we've reached up into this level here. The reason I've got that red line is not only because it was support and resistance going back to late 2022, but it's also the intervention level where the Bank of Japan started to intervene. Yes, they allowed it to get up to about 150, just slightly above 150, but there was the first intervention. But we saw the biggest intervention thereafter, after that initial move down, at precisely the level that we're at now at 146. So a lot of this is going to depend on the dollar. Of course, if the dollar continues to move higher, and we know that the interest rate in Japan and the yield curve control is kind of negative for the Japanese yen still, and so we could see further yen weakness against the dollar. But we're going to have to wait to see what happens. We know that this area right now is an area where the Bank of Japan has taken its largest intervention so far, going back over the last 12 months or so, and that was precisely at the level that we're at now. If we just move along there, you can see we've tried to fall back from there. And I'm going to have a look at the 4-hour chart. This is actually what's called an expanding pattern, or a falling foghorn. Not sure if that's actually the right name for it, but it's something like that. Let's have a look at it on the 4-hour chart and zoom in a little bit to give us a better idea. And remember that the top of this pink zone that we're at now is the 78.6% Fibonacci. Yes, we have spiked through a little bit. You'll see when we zoom in, but it's a really, really key and crucial number. And it's also, you see where this big drop is, also the time and the area where the Bank of Japan and the Ministry of Finance intervened the last time with their biggest intervention. One would think it was at this drop from 150 downwards, down to the level that we're at now. But the biggest intervention was on the attempt for the market to rally back up through that level. So there was some intervention driving it down to this level. We dropped through it once, moved up, dropped through it again, sharp spike, up again and down. And on the third or fourth occasion that the market tried to push back above that 146.50 level, where we are right now, the Bank of Japan, the Ministry of Finance in Japan, just smashed it right down. And we dropped from 146 down to 138 in a matter of several 4-hour candles. So a very, very dramatic intervention. We scoot across to the right. That's exactly where we are at the moment. Let's just get this chart sorted out. Now, I was talking about this expanding pattern. This is what it looks like. So it's a falling bottom and a flat top. Normally in an expanding pattern or a megaphone or a foghorn, it doesn't matter what you want to call it, you'd see something along the lines of this. I'm just going to draw another trend line and sort of fan it out, something like that. And that's possible that we could get that sort of pattern, which would take us up to the top of this foghorn, which would be at around about 148, 149, perhaps 150. And that's, of course, the top where the last time the Bank of Japan intervened, they drove it down to back to where we are at the moment, 146. So it's possible we could get up there, but we are trying to form this flat top megaphone right now. And we know that this area here, scooting back again in time, is that occasion when they intervened with their biggest intervention on the attempted move back up through there. So whether they're going to do that right now at 146.50, or they're going to allow this to drift up above this very, very crucial, very key level. This is the level that we need to be watching in this week ahead, remembering that we've got the jobs report on Friday, the non-farm payrolls, which is going to influence the markets one way or the other. But with a bit of luck, and we're short on this, with a bit of luck, the market will respond, or there'll be some intervention before we get to the jobs number, going back to where we are right now, scooting back across. That's that megaphone. If I remove this top line, you can see this falling megaphone pattern. In other words, a flat megaphone top. So it's not really a megaphone, sort of a megaphone, but not the traditional sort. But it is also a reversal pattern. And if we can hold beneath that level there, maybe just a little spike up through there and back down again. And if we can then break down through this bottom falling megaphone pattern bottom, then we could see ourselves on the way. We might even see some intervention by the Bank of Japan. Often they do it on a Sunday night, which is coming up in a few hours' time. Sunday night, my time, European time. All right, and then the euro yen, the pound yen, Aussie yen, Swiss yen, CAD yen will all follow in suit with that. You can see they've all fallen down by themselves, though. The dollar yen is the only one that's actually trying to reach up through that level. The dollar yen's the only one that's at its highs. All these other ones are closer to the lows. So they've already started to come off and drive the yen a little bit higher against the major currencies. Let's see how that goes. Now, I want to talk about the stock markets. I'm not going to talk about individual names. I deal with those in my private members group. If you're interested in joining up with that, there's a link below to my website. You can have a look at what that's all about. But we talk about stocks like NVIDIA, Apple, AMD, Microsoft, the main ones that I got on the chart, and Tesla and other stocks like that. But I want to show you, and we've been trading quite actively on NVIDIA and NASDAQ and doing really, really well this last week. But I want to show you S&P because it's the sort of broadest market indicator, and show you what I put up on Twitter or X this week or last night, or was it this morning, somewhere around there. And these are the paths that I think we could follow. I have the feeling that we're going to see the markets move higher. I think the dollar's going to come off, and I think that's going to give the market, the stock market, room to move higher and potentially test the all-time high and potentially move higher than that. That's just what I think at the moment. That could be completely wrong. Anything could happen, but that's what I think might happen. I think there's still some legs left in the stock market. But we may have already corrected. We've corrected 5% from the recent highs. This is a weekly chart, so we've had 1, 2, 3 weeks down. Last week was a consolidation week. You can see there an inside week, but it is an inverted hammer candle almost. A little bit of a wick low, but an inverted hammer, often a reversal candle, as you know from my previous videos. and we could then see a move higher from here. This might be the bottom for the meantime, and we might follow path A. Alternatively, and remember this is a really, really key level. I've drawn these two pink zones in as key levels, and this first pink zone is really important. That's why I've drawn a thick green line there as well. That's the previous swing high, the last time we had a dramatic swing high. That's this level here at 43.20-ish. And we've dipped down to that level now. We touched it the week before last, and potentially we're going to move up from there. If that doesn't hold, then we're probably going to have to get down to this next support level at around about 41.60 to 41.80. That's this level down here where it says path B, and it's also this previous swing high on the swing after that first one that I was talking about. So it's a pretty simple chart really. On this move higher, we got up to that swing high, and on this move lower recently, we got to that swing high, and potentially we could get down to the next swing high, which is around about 41.60 to 41.80 before moving up. Failing all of that, if the market completely unfolds, if the dollar goes rocketing higher, or if the banks all collapse and everything else collapses around us, the markets fall apart, industrial production goes to zero, there are riots in the streets, all that sort of thing, housing market, bond market, everything absolutely collapses, then we could see path C. I don't think that's the likely scenario. We're not seeing that sort of thing right now, and we're seeing what appears to be a relatively robust US economy. So I think we've got a chance of bouncing from where we are now, moving up to make a new high above the last couple of weeks and up to the all-time high. Or we could get down on path B. It's not much lower. It's just another few percent lower, I think, but judging by just eyeballing it, probably 3 to 5% below where we are at the moment, and then a move higher. I think path C is the least likely. And I think between path A and path B, it's kind of a toss-up. I don't know. We'll have to see how the bond markets and how the dollar trades next week, and that's going to have a big influence on this. Not a direct correlation, not a perfect correlation, but a sort of a guidance for where this market might trade. If we see the dollar coming down a bit, we could see these markets move up straight away from where they are at the moment, and path A would then be the favored path, breaking through the high of the last few weeks, moving up to the all-time high at some stage. And of course, if you have a look at all of the stocks involved in the S&P and the NASDAQ, they will generally follow the direction of the indices. And if we see NASDAQ and S&P begin to move up, we should see Nvidia, Apple, Microsoft, A&D, Tesla, etc. all begin to move up. Otherwise, they'll move down in sympathy with the rest of the market. I think the only exception, and this is an important exception to all of this, is that we might see some of the chip stocks move in opposite directions. I'm not convinced that Nvidia and AMD have got a lot of legs left in them to the upside at this stage, and I think we could see them coming off, or at least holding relatively steady where they are at the moment, whilst the rest of the market rallies, if that's what the market does. If the market collapses in total, in general, overall, I don't think there's a lot more downside for Nvidia and AMD. All right, having said all that, we're now looking at gold. I'm not going to look at the other metals for now. I'm just going to look at gold. Might just touch on uranium, but gold holding above that level. This is a daily chart. Now we're long on gold. I'm sort of shy of the bigger position that I want to have. I've got a 60% position on gold, but we've fallen down into this yellow zone. It's a crucial key support zone. You can see going back why I've drawn it in. It's a really, really important supply and demand zone going back a long time. And we've just fallen down in there. But what happened last week was we actually had quite a nice little rally. And then we dipped down again on Friday after the Jackson Hole speech by Jerome Powell, and then bounced up pretty sharply. And you can see if I just zoom in, this is a weekly chart again. We've got a weekly tweezer bottom with a bullish engulfing candle. It's a weekly tweezer bottom with a bullish engulfing candle. That's a very positive sign for gold. Whether we're going to hold and continue to move up, I don't know. Like I said, a lot of it's going to depend on the dollar. But this chart pattern, the technicals on this chart are really supportive of gold. And if we zoom in and have a look at the closer time frame, let's start with the day chart. This is the last number of days, the end of last week, forming a beautiful base there, several reversal candles, then a big bullish candle, an expected pullback of about 50%, which is normal, back down to this green line, which is the previous support level. Beautiful pullback down to there. After the Jackson Hole, looked like gold was heading low pretty fast, and it bounced up nicely and closed with this nice wick low. That looks really good on the day chart. And if you have a look on the 4-hour chart, you'll see the same sort of thing. Very encouraging for gold bulls. I don't know if we're going to hold the 1,900 odd level, 1990, 1987, or if we're going to have to go a little bit lower. But so far, so good. I think gold's looking awesome, and I love the way this is formed. Big bullish candle, nice pullback, consolidation, wick low on the 4-hour chart. On the day chart, it looks good. Have you seen that pullback on the day chart? Beautiful pattern there. And on the weekly chart, as I showed you earlier, we've got this tweezer bottom, beautiful tweezer bottom. Tweezer bottom means last week's low was identical to the previous week's low, plus a bullish engulfing candle to go with that. So I think that looks excellent. I'm very happy with that. I'm just going to touch on URA, as I said, the uranium stock ETF, and that one has just rallied up beautiful. We're hoping for a little bit more of a pullback on uranium. We've been long on uranium this whole time, repeatedly. We haven't lost a trade in uranium yet, going back months and months and months. We've just been buying the dips. And we got out actually right at the top here several days ago, just waiting for it to pull back down to this trend line, maybe into this green zone, and maybe even down to the bottom of this range, down into this sort of, I don't know, beige zone for another attempt at buying. But actually Friday's move was quite bullish, so we might have just missed out there. But we're hoping for a little bit of a pullback on URA to get some more long positions on that. And finally, I want to talk about two things on this chart. I'm not going to talk about Bitcoin, not going to talk about sugar or wheat. We might just touch on wheat, but or WTI. I'm not going to talk about those. There's no time. But I want to talk about natural gas, and I'm pretty happy with natural gas. This is the 4-hour chart. Please have a look at the previous video I did on natural gas. These videos always follow thereafter. So you'll see what my thinking on natural gas. I'll put the link at the end of this video and you can have a look at that. But basically we dropped, this is a 4-hour chart. Basically we dropped down through the support on Thursday and then just moved back up again. Big bullish candle, some consolidation, dropped down about halfway, about 50%, maybe 61.8, somewhere around there. And then on Friday, after we had the storage reports and so on, and after Jackson Hole and a bit of messing around on all the markets, we closed Friday with something that looks pretty much like the gold weekly chart, a tweezer bottom on the 4-hour chart and a bullish engulfing candle. Very similar to the gold weekly chart. Of course, it's not related, but it's exactly the same pattern. Tweezer bottom, bullish engulfing candle on natural gas. So far so good. We've got the rollover on Tuesday, so that's going to affect the markets, but it looks like we might roll over to the upside. And I haven't had a look at the sort of adjustments that are going on instruments like the Oranda ETF and that sort of thing, or CFD, whatever they call it over there. But there you can see the adjustments as they creep in. But it looks like that we might see a fractionally higher price on the rollover if you look at the futures price and the way it's sort of begun to adjust on some of the other not pure futures contracts type trades. This is the actual futures contract, the front month, next month's futures contract that we're looking at. So that's a 4-hour chart. And then on the day chart, we same sort of thing really. We've got this beautiful spike wick low. This is the dividing line, this level here, around about $2.45. Below there is bearish, basically going back down to $2. Above here is the bullish line, up to about $3. So we've got roughly $3 to $2.50, the new range that we're trading in, and then $2.50 down to $2, the old range that we were trading in. We needed to hold above that red line on the chart, really. That's actually at 245. I'm just rounding it to 250. But we held above there, and we held above there beautifully. And this is the day chart, and you can see we formed this reversal wick low. It's not really, it's a hesitation candle, so you never know which way a hesitation candle is going to go. But as it turns out, on Friday, after the storage report and after Jackson Hole, which everyone was dreading, could drive the dollar berserk and drive the markets crazy, it was actually a rather quiet day compared to the previous year when everything crashed after Jerome Powell spoke. This year, pretty docile really, including what happened on natural gas. A very small daily move, but a bullish move, little wick low, move higher, back to the underside of this downward, this channel line. We've got to get up through there, so we're stuck beneath this channel so far, and we've got the 20 and the 50-day moving averages above us, quite a long way. We want to see this move up through the 20 and the 50, up through 265, up through 270. I put all the levels in the previous video, have a look at that. But my target is $3 again, and I think we could get a little higher up to the top of this channel. And I'm going to try and just zoom. I've got a little sort of green arrow in there. That's with the 200-day moving averages coming down, and I want us to see us reaching up to there. That's at $3.15. I think on this occasion, on this attempt, we're going to get up through these resistance levels above us more easily than the last time where we didn't get up through there. Let's go back to the 4-hour chart, and I'll show you the levels that we failed at. That's these levels here with the 200 period moving averages, 4-hour chart. And we've got the 20, we've broken through the 20, which is a good start. It doesn't really mean an awful lot. We've got the 50, we've got this channel line, we've got to get up through those. Then this 200 period moving average and these previous highs. If we can get up through there, there's not a lot of space up until about $2.70 to $2.80, this region here in the pink zone. If we can get up through there, then we've got $3 in our sight. And beyond there, I think the channel top at $3.15. That might sound counterintuitive because we know that $3 is a big number, and it might be the stopping point, and it might well be. But if we're going to follow this channel and we're looking a bit bullish, we've got some upward momentum, we might try and reach up to that 200-day moving average, which is at $3.15 today. That's right there. An eventual target, $3.40, 50, 60, or 75. And let me just reset this quickly, trying to get through this. It's a messy chart because we've got this big, every time you compress it, you bring this whole thing into it, and it compresses this zone that we're at now. But we want to get up into that level there at some stage towards the end of the year. I think it's going to take a bit of time. If we can get up through $3 to $3.15, $3.20 maybe, we're going to probably pull back down to $3 and below $3 because we're going to have to clear out a lot of people that have got into sort of late into the game. Bit of FOMO will creep in, bit of exuberance, bit of excitement. A few weak hands will have piled in. We're going to have to clear those out. So if we do get to $3.15, $3.20, I think we're going to pull back to $3 and below. We could get all the way back down to $2.80, $2.75, and then faff around in that range again for a bit of time as we approach the end of the year. So that's natural gas, and I think that's all looking pretty good. I'm happy with that. And that's that. WTI, I don't really have much to say on that right now. I've done some videos on WTI, going to have a look at those. But I think WTI is kind of in the middle. We're diddling in the middle. Is it going to go up or down? I don't know. A lot depends on the dollar, depends on the Saudis, depends on demand, depends on the economy. It might even depend on the Panama Canal, which has run out of water. And I was very surprised by it that it doesn't run on seawater. Panama Canal is above sea level, and it runs on fresh water from various lakes all around that area, which are now dry, and they can't get enough ships through there, and there's a backlog building up. And that will affect not only goods and other things that get shipped primarily into the US, but also transport of oil and gas. So that could have an effect on the gas and the oil price and drive them higher, if anything, until those backlogs are sorted out. And because it's a drought, it's going to take a long time before there's enough water. It doesn't just fill up the dams overnight and the lakes around there, which power the locks in the Panama Canal. It takes weeks and maybe even months. So we could see some major supply problems, not a lot being said about it, and probably not to spread alarm and drive up inflation, which is the last thing the Fed wants, for example. That's just one of the reasons why there's not a lot of hoo-ha about the Panama Canal. And wheat, the last thing I want to look at is wheat. We're pretty bearish on wheat. I've put some things up on Twitter on wheat, some charts, and also some videos I've done recently on wheat, and in my private members room as well. We've been selling into wheat. I'm not actually trading this because I just don't have space in my portfolio at the moment, but I'm looking for wheat to move down from around about 600 cents down to about 400, 450 in time to come. And I think this overall chart is looking pretty bearish on wheat. So that's just my overall view. If you want more details on that, go and search through my Twitter channel or previous videos, or just join up with our members area. Again, if you've enjoyed this video, please give it a thumbs up and consider subscribing to the channel. It really helps me, helps get this out, and the contributions that the advertisers make to these videos when you watch them doesn't cost you anything, but the advertisers pay for it, and those few pennies that I get go towards me paying for things like Reuters and Bloomberg and the other news services that I get information from that I have to pay for. So thank you very much for that, and thank you for your support. Have a fantastic trading week, and I'll see you in the next video. Take care.